It was 2 a.m. on a rainy Tuesday in 1995 when the chief executive of Barings Bank got a call that a single trader had just erased £827 million in a single night. The name on the frantic report? Nick Leeson. The oldest merchant bank in Britain, a name that had once financed the Duke of Wellington's victory at Waterloo, was teetering on the edge of oblivion. How could one man, a junior trader, bring down a 233-year-old institution in the blink of an eye? Barings was more than a bank. It was a symbol of aristocratic finance, a pillar of the city that had survived wars, depressions, and revolutions. By the mid-1990s, it still carried a capital reserve of £300 million, enough to keep its 1,000-plus employees breathing easy. Nick Leeson, 28 years old, had arrived in Singapore just a few years earlier. He started as an accountant, but his talent for spotting arbitrage opportunities quickly earned him a promotion to head of futures trading on the Asian desk. In 1992, he turned a modest profit of £10 million in 6 months, and the senior partners, hungry for high returns, gave him unprecedented autonomy. They even let him run a secret account numbered 88888, away from the usual checks and balances. The market in 1994 and 1995 was a volatile playground. The Japanese Nikkei index was wobbling, and traders were using massive leverage to chase quick gains. Leeson believed the market would rebound, and after a modest loss on a short position, he made a bold choice: double down on short Nikkei futures, betting that a swift recovery would wipe out the deficit and restore his streak of profits. Each contract represented £10 million, and he was effectively wagering £200 million of the bank's capital on a single directional move. To him, the secret account insulated the bank from scrutiny, and his track record gave him confidence that this gamble was just another calculated risk. Then, on the 17th of January, 1995, a 7.3 magnitude earthquake struck Kobe, Japan. The disaster sent the Nikkei plunging 15% in a single day. Leeson's short positions exploded, turning a potential £100 million profit into a £400 million loss overnight. Panic set in. He began falsifying trade confirmations, moving money between accounts, and convincing senior managers that the losses were temporary, hoping he could recover the money with even larger bets. The fear of being fired, the sunk cost fallacy, and his belief that he could still turn the tide drove him deeper into the abyss. By the 26th of February, auditors finally spotted a mismatch in the accounts. The hidden loss was revealed. £827 million vanished from Barings' books. The senior partners stared in disbelief as the numbers unfolded, realizing that the secret account had been a conduit for a catastrophic gamble. The bank's capital reserve was nowhere near enough to cover the hole, and the regulators moved quickly to freeze assets. Within days, Barings was declared insolvent, its name erased from the London Stock Exchange, and its employees faced an uncertain future. What do you think about the choices that led to this collapse? If this is blowing your mind, hit that subscribe button, and let's keep exploring together. The fallout was immediate and brutal. Within hours, the board convened in a cramped conference room, the air thick with disbelief. Senior partners who had once toasted to centuries of stability now stared at a spreadsheet that read, £827 million missing. The chief executive, a man who had spent his career navigating the delicate balance between aristocratic tradition and modern finance, could barely keep his voice steady as he announced that Barings would be forced to sell off its assets to a rival bank. The buyer, a German institution with deep pockets, stepped in to acquire the remnants for a fraction of what the bank had once been worth, effectively ending a 233-year legacy in a single night. Employees received terse letters telling them that their positions were terminated, their pensions frozen, and their futures uncertain. The news rippled across the city of London, sparking a wave of headlines that read, "Barings falls, and traders' folly shakes finance. In the weeks that followed, regulators launched a full-scale investigation, uncovering a cascade of internal control failures, a culture that prized profit over prudence, and a glaring lack of oversight on the secret account that had become the conduit for the disaster. What caused this catastrophic collapse? It was not simply a single bad trade. It was a perfect storm of human psychology and systemic weakness. First, the unchecked autonomy granted to a single trader created a blind spot that senior management never saw. The secret account, originally intended for legitimate hedging, became a black box where losses could be hidden and later amplified. Second, the relentless pressure to deliver ever greater returns pushed Leeson to double down when the market turned against him, a classic case of the sunk cost fallacy. He kept betting larger sums in the hope of recouping what he had already lost. Third, the lack of proper risk management frameworks meant that there were no limits on the size of positions he could take, allowing a single individual to expose the entire institution to a gamble that dwarfed its capital reserves. Finally, the cultural environment at Barings, steeped in tradition and deference to senior partners, discouraged questioning and critical oversight, leaving warning signs ignored until it was too late. The lesson here is stark and timeless. No amount of prestige or history can shield an organization from the dangers of unchecked risk and hubris. Robust internal controls, transparent reporting, and a culture that encourages dissent are not optional extras. They are the very foundations that keep a firm from teetering on the edge of ruin. For anyone watching the markets today, the Barings saga serves as a reminder that a single decision, driven by fear, greed, or overconfidence, can erase centuries of goodwill in an instant. So, what would you have done in Leeson's shoes? Would you have taken the gamble, hoping a quick rebound would erase the loss? Or would you have raised the alarm, even at the risk of your own career? The answer isn't simple, but reflecting on it can sharpen your own judgment when faced with high-stakes choices. As we close this chapter on one of the most dramatic financial collapses of the 20th century, remember that the story isn't just about numbers, it's about people, ambition, and the fragile line between success and disaster. The next time you hear a headline about a massive loss or a sudden windfall, ask yourself, what hidden risks lie beneath the surface, and who is watching the watchman? If this deep dive into Barings' rise and fall sparked your curiosity, drop a comment below with your thoughts on the biggest lesson you took away. And if you want more stories where money, risk, and human drama intersect, give this video a thumbs up and hit that subscribe button so you won't miss the next episode. The world of finance is full of hidden twists. Stay tuned, stay sharp, and keep questioning the next big decision.